So just how real is the prospect of a Greek restructuring, and what impact could it have on the rest of Europe's debt-ridden nations? David Watts, European credit strategist at CreditSights, joins me now. David, thanks for joining us today. The ultimate cost. This is a phrase I know that you've been writing about. The issue comes back to not knowing the ultimate cost. So if Greece does restructure, the knock-on effect, maybe people haven't really thought it through.
Yeah, I mean, my view of the situation is that when people talk about a restructuring, and that's particularly restructuring in the near term, they're confusing the time frame that markets apply to this versus the politicians' time frame. And the reason for that is because there are knock-on effects for a restructuring in Greece. The main one, of course, is Spain. It's possible that if you lay out a roadmap that resolves a debt sustainability problem by asking private sector creditors to take losses, then you could shut the market to other Eurozone countries, particularly the stressed ones, and that's Spain, possibly even Italy, although Italy at the moment looks relatively robust. The next problem, of course, is you're not convinced how much of a second-order banking crisis there could be. We've had the stress tests, we've got second ones coming up. But even with those, it's possible that you'll need to recapitalize the banking system, and that could be an additional cost way beyond what you're expecting to pay for Greece. And then even beyond that, you'll have costs for Greek voters in the Social Security Fund, the pension fund, and the household sector.
So we should be wary when using the restructuring word. Is that what you're saying?
I think so. I think you should be wary, but also you should just appreciate that just because it might be better for the market in that it resolves the uncertainty, it's not necessarily better for either German or French politicians or for Greek politicians. It's not necessarily a vote winner.
Yeah, but in the meantime, the rhetoric is growing, isn't it, from both politicians, and just look at bond yields. They're telling us that, you know, a bailout of Greece, not a bailout of Greece, a restructuring of Greece could and may well be on the cards. So with that in mind, is it just a matter of time?
Well, I think it's very difficult to paint a picture in which you resolve Greece's debt sustainability questions without some form of restructuring at some point, unless you are prepared to lend to them at very low interest rates for a very extended period of time. The problem, though, is that just because bond markets are saying that a restructuring is likely now, and the CDS curve is inverted around the one-year part of the curve, that doesn't necessarily mean that it's going to happen now. And certainly the political rhetoric has been rising, but the political rhetoric has been high throughout this. There's been an eagerness on the part of politicians to try to avoid moral hazard, to try to avoid being seen to bailing out these countries. But every time that they've actually been forced to provide the funds, they've actually stepped up to the plate, reluctantly, certainly. But they don't seem to be prepared to answer the really difficult questions that they would have to answer in a restructuring.
Yeah. Where is there value to be had, David? I mean, you talk about pockets of value within the European credit markets. Where is this value to be found?
Well, we're predominantly a corporate shop, and so we are focusing on corporate credit. Within that, we have a preference for short-dated, high yield. That's performed very well, and it's possible that in the run-up to the end of QE2 that will start to become a little less certain. Within the government space, we continue to look at Greece as possibly an opportunity, although clearly it's a lot of volatility here.
Right.
We don't like the bonds because after 2013 you'll have to renegotiate a new loan facility, or you'll have to come back into the market, which at the moment looks very unlikely. But the point with the T-bills is that they're 3 months or 6 months. Now the 3 months, it's very difficult to see how you could run out of money within the next 3 months. You have the EU and the IMF, so unless something happens with Finland or another small country to deny you that those funds, it's difficult to see how you wouldn't have the liquidity. What's more, it's the 3 month. Once you get to that point, you are unlikely. Sorry, I forgot my point actually.
Yeah, but you're talking about T-bills, Greek T-bills.
Yes.
Why we should, of course, buy them, but they're only selling bills, of course, up to 3 and 6 months, aren't they, right now?
Yes.
So because you've got the Europe backstopping them, they're basically a generous yield. Is that the argument?
Yes, I mean clearly they're not risk-free. There's still some political risk here, and as we've seen throughout the crisis, politics keeps rearing its ugly head and creating new crises when it seems that everything has become a little bit stable. But with the 3 months in the 4 region and the 6 months in the sort of 5.5 region, it's very difficult to see how you can have that liquidity event, that crisis event, that would actually catalyse losses on those instruments.
Okay, David, thanks for joining us today. CreditSights, David Watts there.